when most people think of budgeting, they think of an operating budget. That's what we're going over here, where we'll talk about forecasting revenue, forecasting expenses, and then therefore forecasting net profit. The other two are capital budgeting, as I mentioned, which is forecasting the profitability of projects and investments, and financial budgeting, which I'll put a video out later on, which is the forecasting of cash flows. So we'll get into this. I'll put into a link down in the description where you can download this very same spreadsheet that I'm referring to here and tinker around with it. A operating budget starts with, it has a bunch of sub-budgets in it, I guess you could call them. And it starts with forecasting sales, because demand is what drives everything in a business. So, you know, the amount that you'll make, the amount that you'll purchase, the amount of labor that you'll plan to hire, etc. All is going to start with the amount you plan to sell. This particular budget here is operating budget, excuse me, is for a hypothetical manufacturing business. There are obviously other types of business, other types of industries. The manufacturing kind of requires the most depth in terms of, you know, all the different sub-budgets, production budget, direct materials, labor overhead, inventory, so on and so forth. We'll get into all of those. So it's kind of the most, I figured it was probably the most comprehensive, and you know, really a budget for any other type of business, you would probably just start pulling out those sub budgets, and you know, the same general principles are going to apply. Now, with any of my workbooks, spreadsheets, I make it available on the website there. Just so you know, going forward, these white cells are the variables where things can be changed, and then all the colored in cells are either text or formulas. So if you download, you're free to do whatever you want with it, but you know, if you want it to function as intended, if you know, then don't do any of that. If you know what you're doing, then by all means, you know, go and change it, make it your own, do whatever works for you. Let's see. Okay. This is one of my biggest, if not my biggest, spreadsheets that I've created, just in terms of all the different variables. You know, it's certainly not the most complicated, but there's just a lot of, like I said, with all the different sub-budgets to cover. So I'm going to do my best to kind of move along at a pretty brisk pace. I'm not doing so good on that so far, but I'll work to pick it up a little bit here to try to get through it in a somewhat timely manner. And, you know, once you get me started talking on these sorts of things, you know, spreadsheets and all that, as silly as that might sound, you know, I can ramble on for quite a while. So I don't want this video to be like half a day, like 4 hours or anything. I'm going to try to keep it well under an hour. So there are some concepts in here that I might come back to later. Specifically, I know in the executive summary worksheet, there's 2 of the ratios on there which I'm working on expounding upon right now with the example spreadsheets, and hopefully not long after that with videos. So let's get into it here. The first step in budgeting, as I mentioned, is a sales budget, because everything is going, all of your other planning is going to be based on your expected demand. So the first variable here is kind of a bummer, but it's the percentage of sales assumed to be uncollectible. And that's exactly what it sounds like. It's the dollar percentage of your sales that you expect that you won't be able to collect on. It's a reality of business, unfortunately. Customers run into cash flow problems. Customers don't pay their bills for whatever reason. Most do, but some won't. So, for the sake of comprehensive planning, we want to make sure that that is taken into account. So the example used here is 7.5%. Okay? Excuse me. Over here, you're going to see where we kind of enter our SKUs, stock keeping units, whatever you want to call it, item numbers, product numbers, blah, blah, blah. We just kind of go with a generic item 1 through 5 here, just so you can kind of track individual items through the entire operating budget process. I use the same item 1 through 5 examples in more or less all of my spreadsheets. So your business probably has more than 5 items for sale, and that's of course probably good because that translates, I'm sure, into more sales for you. But like I said, these are big spreadsheets, so to keep them halfway reasonable, I'm only using a company with 5 items as an example. So this is the unit sales budget up top here. Like I said, this percentage of sales assumed to be uncollectible is for actually down here, translates into the dollars, so it should probably be down here, and then that way wouldn't start the spreadsheet off with it. So that's a tweak I might make in the future. But anyways, for each item, you enter your forecasted item sales, okay, month by month over the upcoming year. So once you have an idea of what your units are, I will throw out there also that in the near future, next probably 3, 4, 5 videos will be a forecasting spreadsheet that I created, and that obviously should come in super helpful when it comes time for the operating budget, but can be used across for expenses also, and particularly can be used in the capital budgeting. So after we have the units entered, we move down to the dollar budget, and the dollar budget is taken from units to dollars based off of this average sales price. Now, sales prices can change throughout the year, of course. Rise, fall, sales can happen, markdowns, blah, blah, blah. For the sake of simplicity, it's kind of assumed that there would be an average sales price entered here, okay, over the course of the year for each individual item. So the math gets done down here. This is the total by item in this column, and this is the total by month for each item, January through December of 2019, and all that is the sales price multiplied by the units in a given month. See here on the gross sales line how we have a estimated gross sales sum of all the items for a given month. Then, that's right, we got to address those pesky uncollectible sales, and those are entered down here and deducted from the gross sales to give us a net sales amount. Okay, so that's the sales budget. Pretty simple, pretty straightforward. So now we know what we plan to sell. Now, and here's the thing too about, let me say this about the operating budget, that for as, I don't want to say complex because it's not terribly complex. It's pretty simplistic, pretty intuitive, easy to follow along with, but is just with all the all the worksheets in here, all the sub budgets and everything. There's relatively little information you have to enter. Like I said, the biggest, the thing that's going to have the biggest effect across everything is what gets entered on this sales budget. You can see it's pretty straightforward. Enter units, enter sales price. Okay, so knowing what we're going to sell in terms of units in the coming year, then we can start to decide what we're going to produce. Okay, because we don't want to produce more than we're going to sell, because that'll just tie money up in inventory and hurt our cash flows. We certainly don't want to produce less and leave sales on the table, so we want to make a plan for what the appropriate amount to produce is. Now, the only field you're going to enter here is this percentage of next month's sales in ending inventory. This is kind of our buffer, our safety stock, so to speak, that, you know, we understand that our unit sales projections are going to be wrong. Okay, it's forecast, it's going to be wrong. We hope it's wrong, you know, minimally, not really wrong, you know, either way, not really pessimistic or really optimistic. We want it to be, you know, in the neighborhood of what reality is. But, you know, that being said, we want to leave ourselves a little bit of a buffer here to where if demand is higher than we forecast, we've got some safety stock there in inventory. Okay, and with all that said, it's a good point to make about when it comes to budgeting. I mean, you've just got to accept it's going to be wrong. Okay, it's the degree of wrongness that you should worry about, and you know, hopefully you can keep that to a minimum, because being wrong in your budgeting and your planning means that you're making decisions that are not optimized, you know, for reality. And you want to, and that's why, you know, I bring up that forecasting workbook that I made, because, you know, there are some easy to apply but yet, you know, complicated on the back end forecasting strategies there that can hopefully help you, you know, minimize the amount of wrongness you have. So anyways, this percentage of next month's sales and ending inventory, we're going to say 35%. Nice buffer there, about a third of sales, you know, as a safety stock for the following month. So this is what we need to produce for each item. We got 1, 2, 3, 4, 5 here. Okay, we've got our budgeted unit sales. This ties back to the sales budget. You see 1205, 1210, 1205, 1210, and so on. Then we've got the ending inventory. Okay, so this is 35% of next month's sales, 424. Okay. And it refers back to the sales budget, but it's, like I said, 35% of the next month, and then minus what we're going to start the month with. So we're going to start the month with 422 units, okay? We plan to sell 1,205, and we want to end the month with 424, okay? So we take these two, what we plan to sell plus what we want to end the month with, okay, but then we take out what's already made, and that leaves us with what we need to produce. So you see the difference here. We want to end the month with 2 more units than we started it with, so we're going to produce 2 more units than we budgeted we sell. Okay, that same formula is applied all the way across here for every single item, and it gives us a grand total here of the number of items that we'll plan to make over the coming year. Okay, so we know what we're going to make. Next, we need to kind of break down what it takes to make those individual items. Okay, so here, these are pretty simplistic bills of materials for each item. Item 1, 2, 3, 4, and 5. You can see these information in here, direct materials, just like direct material 9, 10, 5, 1, 2, whatever. They're all separate item numbers, product numbers, SKUs, whatever you're going to call them. Then each has a quantity and an expected cost per unit. Okay, so this is our standard cost. Standard, expected, budgeted, these terms are all synonymous. Okay, this is on average what we're planning to spend for direct material 9 over the course of the year. If you look, see 518, it should be the same because direct material 9 gets used in the bill of materials for item 2 also. Only one of them as opposed to 3, but it will also expect to pay 518 for it. So extended cost is simply the multiplication of the quantity times the direct material cost per unit. So that's the total value of that direct material in the bill of materials, and then when you add all of those up, all the extended cost stuff, you get a total material cost for each finished good, each item here. Okay, so knowing what we expect to pay, how much we need, and that we get to the direct materials budget, which is this is kind of a big old spreadsheet here because it breaks not just each finished good item down, but each direct material in each finished good item down. Okay. Now we're doing the same thing here we did on the production budget. We're planning for how much we want to have in safety stock. Since this is for production, not for sales, we'll back it off a little bit and just say 25% rather than 35% of the what's needed the following month in safety stock. So direct material units for production, you see it's item 1, direct material 9. Okay, go back to our bill of materials, we're just starting right here. Okay, this is the amount needed for production. So in this case, it's 3, the quantity in the bill of materials, times, it refers back to the production budget. Oops. 1207. Okay, so 3 times 1207, if we just double check that here, is 3621. Okay, see, that's what we've got here. So we know we're going to need 3 direct material 9s for every item 1 we plan to make. What was it, 1207 item 1s in January. Here we go. That's how we get that. Okay, so that's the number of units we're going to need in January for this particular finished good, item 1. Now keep in mind, DM9 was also used, direct material 9, in item 2. So there's another 1,058 that we'll need for it in January. Okay, and it's less because we plan to manufacture a different amount of item 2, but also there's only one DM9 in each item 2 that we make. Okay, so we'll consolidate all this information at the bottom of the direct materials, so we'll know exactly what we need of each direct material. So same principle here, ending inventory. Okay, what is it, 25% of the following month? Look at this. Yep, there's the following month times 25%. We want to have 908 DM9s in inventory at the end of the month, solely for the purpose of being used in item 1. We want 265 DM9s in inventory at the end of the month, solely for the purpose of manufacturing item 2. Again, all that will be consolidated later. Then we've got what we're going to start the month with. Okay, 905. And, what's the difference there? 3. So how many are we going to need to purchase for January DM9s for item 1? 3624. Okay, 3 plus the 3621 we'll need for production. Okay, this is what we want to use in production. This is what we're going to have at the end of the month, and this is what we're starting with. So that gets subtracted. Okay, the units to be purchased for each direct material, finished good, combination is sum there, informational purposes. Here's our cost. In theory, you could change this cost over every month, but again, with a standard costing system, which is what a lot of manufacturers use. I mean, some will use FIFO, weighted average possibly, but the vast majority that I've seen are going to use a standard cost, which is basically, we're going to say, one cost for the entire year. And then it's really a matter of beyond the scope of this to kind of get into the financial accounting side of that, where what you do when you actually pay less or more than that. But one thing, that's another spreadsheet coming down the way, is monitoring that and trying to figure out where your variances come from. So if we're paying more than 518, we want to find out where. And if it's paying a lot more, we want to find out why. On the other hand, paying less, find out where, and a lot less, want to find out why. Okay, but all that will be covered later in the I think it's performance measurement kind of section of the website. And then like I said, those all have videos too. So well, with all that information in there, what do we get? We know how many we're going to purchase. DM9s for item 1 for a month. We know the expected cost, budgeted cost, standard cost, we're going to call it. And here's what we expect to pay. Okay, total that up, and we do same thing for each direct material, for each finished good. Okay, this is kind of the most involved part. As you can see, there's a lot to take into consideration here. But like I said, you can see the direct materials are used across a couple different items. So, one other point I forgot to make. So for every item, finished good, item 1, 2, 3, 4, 5, you'll see a total direct material cost, which will sum these amounts. Okay, so based on the amount we plan to sell, therefore the amount we plan to make of each item, therefore the amount of direct materials we're going to need to make those, and what we want to keep in safety stock, all that gets taken into consideration to give us a grand total direct material cost for each item. And down here we've got a handy dandy pivot table, and if you're not familiar with what a pivot table does, that's fine. But essentially what it's doing, it's going up and looking for every instance of direct material 1 in January and giving us a grand total of what we're going to spend. Okay, so it's consolidating all the direct material 1s, all the direct material 10s. This downside of a pivot table, it's not very good at sorting, in that it thinks direct material 10 goes after direct material 1. In any event, it does accomplish ultimately what we want it to do, and we have grand total expected spends for each direct material item for each month. Okay? And for the year. So that covers the direct materials budget. So materials are just one piece of the pie for manufacturing. The other pieces are direct labor and overhead. So we will make separate budgets for each of those. Now, the direct labor budget is similar in some respects to the direct materials budget, because we're basically, instead of putting the amount of materials we expect to use for each finished good item, we're going to put the number of man hours we expect to have to use to manufacture each finished good. So you can see each item's different. And to clear up, what are man hours? Well, that is basically the amount of time it takes to produce a unit times the crew size, okay? So if it takes, we look at item 4 here, it's kind of simple because it's a nice round number. Maybe it only takes 1 hour to create an item 4, to assemble all the direct materials, okay? But it takes 3 people to do it, or we want to have 3 people doing it. It might not be necessary, but that's just what we've decided to have for our crew size building item 4s. So the man hours is 3. Okay, 1 hour of actual time times a crew size of 3 times 3 people, 3 laborers. Then, of course, the other part that's important is to put in the direct labor cost per hour, and that can vary by item, and it'll also probably be an average, like the cost of the direct materials, because over the course of the year, certainly people get raises, people are hired, people leave their job, people are let go, things change, but we want to come up with that standard cost for each particular finished good in terms of labor, just like we did material. Okay, direct labor cost per unit is simply multiply it out. 2.9 times 13.93, $40.40 is what our budgeted amount of labor for item 1 is, per item 1. Okay, for each one of them, $40.40. You can see, of course, the same thing is done for each item. Okay, so down here we get into a little more detail where we refer back to that production budget. Okay, and what we're doing is just taking the amount we plan to produce for a given month, and we're taking it times the number of hours each one is expected to take. And hours, also like labor rates, could vary. Our people building this stuff could get a lot more efficient at it and do a lot faster. Okay, or our skilled labor could leave and we're left with new hires and nobody qualified to train them, and it could take a lot longer, a lot of trial and error for a while. So hours like rate can fluctuate, which rhymes. So the direct hours needed for the production of each item down here, what we're going to produce times the standard amount of hours. Okay, take that out for every month. We've got our standard rate, direct labor rate per hour for labor. Okay, $13.93 in the case of item 1, and just multiply it out. So we plan to spend $48,759 building item 1s in January, $48,921 in February, so on and so forth, and then each finished good item is totaled. Okay? And then you can see they're all very different. Down here at the bottom, we have a total direct labor hours, which is just a sum of the hours needed for production. Okay, so total by month, total for the year, then a grand total of labor costs by month and for the entire year. And then finally here, this is kind of a weighted average direct labor rate. So it's the amount we plan to spend divided by the number of hours. And you can see that's pretty consistent across the year, but generally climbs. And you say, well, why does it climb if the hourly direct labor cost per hour is the same for every item across every month? Well, just because of the different mix in production. It would climb then because we plan to make more of the items that cost a little more, that have higher direct labor costs per units, okay, as the year goes on. We're going to make a little more of those higher cost units, at least in terms of labor. All right, direct materials down, direct labor down. That leaves overhead. Where are you at, overhead? Okay, here's overhead. Excuse me. So, to get Overhead could be one of those things that's a subject unto itself, like so many other things, but anyhow, it's broken out into two general types here. We've got fixed, we've got variable, and the simple definition of those two is fixed overhead includes those expenses that aren't direct materials, they aren't direct labor, and they aren't expected to change over the course of the year. Okay, fixed. Things like, lease payments for machinery, salaries for supervisors, those aren't going to change. And then supervisors, we'll say aren't directly involved in production here. They supervise and they get paid a salary, so that doesn't change. And flip side here is variable overhead. Okay, these are expenses that you would expect to more or less fluctuate with production. More production, more variable overhead. Less production, less variable overhead. That's a tricky one. I guess probably the best example I can think of, because direct materials and direct labor are both direct costs, so they're both obviously variable. If we make less, we should spend less on materials and should spend less on people building stuff. Conversely, more. The best example I can think for variable overhead is freight in, okay, which is what we pay for transportation for our direct materials that we get shipped in. If we're building more, we're going to ship in more direct materials, and therefore we pay more in freight in. That's kind of the best one-to-one comparison that I can make in terms of a variable overhead expense. I think a lot of the other variable overhead expenses are there's a very loose correlation. It's a subjective sort of thing though. Some people might see it differently. I tend to think, unless it's like very closely tied together, I usually lump as a cost accountant most expenses into fixed overhead. Anyhow, so we have, and this would be done separately, basically line by line for all your overhead accounts, what you would expect to spend over the coming year, and we'll put that grand total in here, okay, for variable overhead. Here's our total expected direct labor hours. This refers back to the direct labor budget. Right here, 234,104. Okay, so why is that there? What do direct labor hours have to do with variable overhead? Well, again, subject unto itself. Could do a whole video on it. The simple approach to applying overhead to finished goods is to do it by direct labor hours. Now, there are plenty of arguments that can be made that that's not appropriate, that's not costing things accurately, and there's a lot of validity in those arguments. And that's another thing that will be covered in a later video and later spreadsheet is, kind of an alternative method of applying overhead, okay, more accurately. Particularly it's called activity-based costing, which should be, if done thoughtfully, considerably more accurate than this. But here's the thing: this is a big involved process, and for the sake of simplicity, we're gonna, in this example, apply variable overhead on the basis of direct labor hours. So what does that mean? For every direct labor hour that gets applied towards a finished good, we're going to tack on, and its cost, its corresponding cost, we're going to tack on $7.37 to account for what we expect to spend in variable overhead. Okay? Fixed overhead gets treated a little differently. It is basically getting allocated. Every item has its own chunk of fixed overhead. Okay, so what we did here is basically took this fixed overhead amount and we're dividing it by the number of months, which is 12 of course, and the number of items, 5. So divided by 60. You can see the formula here. It's a little convoluted, but we should just be able to say that divided by 60. There, 18,863. Okay. Speaking of which, I delete. I don't want to leave my stray formulas, so okay, we're good. Alright, so like we did in the direct labor budget, we know how many direct labor hours we expect we're going to need on a given month for a given item. List that out here. We've got our variable overhead rate per hour above, and here's the amount that we expect to allocate of variable overhead to each item. Simple as that. Okay, so total direct hours needed for production, 42,952, should match what we have on the direct labor budget. And did I total them? I don't think I totaled hours. Nevertheless, 42,952. Okay, so it matches. Alright, so we multiply that. Here's our allocated variable overhead. You know, it changes because it's variable. It changes with the number of hours we expect to need for production month by month. Okay, this climbs over the course of the year for item 1 from 3,500 to 3,660. You know, so allocated variable overhead climbs accordingly. But then we've got allocated fixed overhead. Remember, by month, 12 months, by item, 5 items. Okay, so it's where we've got that 1.1 million above there gets broken down to 18,863 per month. That gets spread out evenly because it's fixed overhead. Okay, and when we sum the two, which is what we do, total allocated overhead for each item, we get these amounts per month. Okay, and a grand total for the year. With that grand total for the year, let's see. I gotta jog my memory on what I did here. Okay, we get a divide. We take the total allocated overhead divided by the total hours, and then we get an amount per hour. Okay, so this 542,914 divided by 42,952 is this 1264. We know that's per hour. Remember, okay. Then the number of direct labor hours per unit, 2.9, which of course comes from our direct labor budget, 2.9, and the total expected allocated overhead per unit is $36.66 for item 1. Okay, so each item, each finished good is going to have a different expected overhead per unit. Okay, varies. $36 there, $28 there, $30, $40, and $22. We come down here and we have a little summary of each item. And the total allocated cost by month, by year, and grand totals. And we do what we did kind of with the direct labor budget and calculate an average overhead dollar amount per direct labor hour of the company. You can see it goes from 12.20, kind of fluctuates. All having to do with the fluctuating amount of production and direct labor hours of production. So all this down here is just kind of for informational purposes, but important to know that our grand total overhead, 2857, 2.8 sorry, I shouldn't read the numbers out. I should say what the actual number is. $2,857,136. And that comes pretty close here, 2858,030 for our sum. I would have to investigate why that isn't spot on. I would guess it is just a rounding. And it's within $1,000, so it's not a material difference. I would guess it's because I do use rounding in some of my, see, like I'm rounding the allocated dollars per hour here, and that's probably what it is, why it's not spot on. That does bother me though, because I like things to be exact. Alright, so direct materials, direct labor, and overhead are addressed. So we want to plan then for what our finished good inventory is going to be at the end of the year and what its value is going to be. So we're looking at December of 2019 totals, and we pull all this information. Our ending inventory, which should come from the production budget, 443. Ending inventory, okay. Cost of direct materials in December, direct material budget. Let's see. Remind myself of that. Oh, okay, that's multiplying out then our per unit. So 2556 is what I should be looking for. And that's somewhere here. Sorry, I'm kind of fumbling with myself here. Bill of materials, okay, it comes from the bill of materials. 2556 total material cost. Okay. Same thing, direct labor, and then our overhead cost. Direct labor will come from then the per unit 4040. Okay, you see that here. Then the cost overhead 3666. I remember that number, comes from here. Okay, so we got a per unit cost, then we know what our ending inventory plans to be for item 1. Multiply them out here and sum them up. At the end of the year, we plan to have 443 units of item 1. The value of those units will be $102.62, giving us an ending inventory valuation for item 1 of $45,461. Okay, as usual, this gets done for every single item, and here's our ending finished good inventory for all items. 338,224. Okay. This will calculate out automatically, of course, based off of what you entered on these previous budgets. Move on to the cost of goods sold budget. Okay. Same principles. Okay. Got each item here for beginning finished goods inventory. The quantity, which comes from the production budget, way back here, 422 for item 1. See, beginning inventory. Now it's listed as negative here for the purposes of calculating this, but in this case it's positive. We got our value from the previous screen for each item. You'll see these are the same for beginning inventory, manufactured units, and ending inventory. And it gets multiplied out. So same thing, it's just the quantities that are different. Doing the same thing here with beginning finished good inventory that got done with ending finished good inventory. Okay, you see these amounts are just the inverse because they get subtracted out when calculating cost of goods sold. But the total is the same as 338,224. Remember, that was right down here, the total value. Okay, so we have what we're going to begin the year with. Then we have what we're going to manufacture. This amount comes from the production budget. We were going to produce a total of 14,811 right here, item 1s. 12,864 of item 2. See, so on and so forth. Each item, here's that valuation. It's the same as it is up here for beginning, same as it is for ending. Multiply it out. There we go. Cost of goods manufactured. Okay, that's what you call the sum of these amounts. So if we take the cost of goods manufactured plus the beginning inventory, this is cost of goods available for sale. Okay, the terminology makes sense. It's what you start the year with plus what you're going to make, and that's what you have available for sale. We take out what we're going to leave in inventory at the end of the year, and then we have cost of goods sold. All right. Then the final piece of the pie, and it's maybe too simplistic, but in any event, it's all the other departments. Okay, so these are all our selling, general, and administrative expenses. Okay, the other departments that aren't directly responsible for procuring, manufacturing, and then making available for shipment all of our finished goods. It's once they're shipped, though, they're sold, so those expenses go down here in SG&A. That's why you see shipping there. Okay. So we've got our departments here, and this is probably the sort of thing that if you were doing this in real life and not referring to a hypothetical example here, you would probably itemize this a little more detail to forecast how things might change. But one thing I want to point out, what are we doing here for each department? We're kind of classifying it as fixed or variable. Now it's very general because there might be expenses in in the finance, the accounting department that are definitely fixed. I'm sure a lot of salaries in there, but they might be semi-variable too, in that they would fluctuate depending on the amount of business the company does. So this is just kind of a general classification. What are 50% or more of the expenses? Are they fixed or variable? That's kind of how you might look at that. So shipping, obviously, is set to variable. Okay, the more we sell, the more we're going to ship. We'll consider that department variable. Sales and marketing, same thing. The sales guys, the more they sell, the more we're going to pay in commission. Therefore, it's listed as variable. So this is real simple, straightforward. Everything, expenses forecasted out over the course of a year, and so summed for every month, and then summed in total year for the whole year in grand total SG&A expenses. So finally, we have worked our way through each budget, and we get to see the fruits of our labor. Okay, in the form of a pro forma, which means expected income statement. All right, so all we got to enter here is a couple of other things that weren't addressed over the course of all those budgets. We're going to have our tax rate of 21%. Okay. And we're going to see net sales. That's going to come from the sales budget. Cost of goods sold. Okay, that comes from cost of goods sold budget, of course. See here. Net sales minus cost of goods sold is gross profit. Operating expenses comes from the SG&A budget. Okay, gross profit minus operating expenses gives us our operating profit. All right. From that, we just take into consideration interest and taxes. Okay, these would have to be entered manually because they're necessary for the pro forma income statement to arrive at a net profit, but you're not going to address interest and interest expense in an operating budget. You will address that in the financial budget that we'll cover in a later video. So we're not a bank or a manufacturing company, so interest income is considerably less than interest expense. We borrow more than we have collecting interest in a bank account there, just due to the nature of our business. But any operating budget, operating profit, minus interest expense plus interest income minus taxes gives us net profit. So, hopefully you can see what the benefit of undertaking, and it is quite an undertaking. Granted, it's involved, no doubt about it. But you've thought about it. You've played with the numbers. You could do. That's one thing I did on my church operating budget example, and something I'd like to work into this someday is a best case, worst case scenario. Little thing where you can kind of toy around with if sales are more, expenses are more, what the effect would be on net profit and what it would be on these ratios down here. So, by doing this planning, you can sit here and say, if things go according to plan, and I gave the plan a lot of thought, this company will earn a net profit of $1.4 million next year, and then you have to decide if that's good enough or if you need to go back and make changes to the sales budget. What happens to the units sold if we change the price? Okay, can we make more if we raise the price and sell a little less, or can we make more if we lower the price and sell a lot more? Usually the former's more true than the latter, but this is why you plan, so you can kind of see, you're looking into the future here, and you can decide if you like what you see, and if not, you can address things proactively here in January of 2019 rather than the last week of December 2019. Okay, so that's the point. This is, this is kind of my bread and butter. I know it's not everybody's favorite thing, but this is why you do it. Okay, so plan ahead, be proactive, stack the deck in your favor going into a new year. So the last couple of things to address here are the ratios, and there aren't too terribly many of them. We've got profit margin, okay, which is simply net profit divided by net sales, okay. How much of net sales do you take down to the bottom line? In the sake of our little hypothetical company here, it's 9%. That's all going to depend, there's no good, bad, or whatever. Higher profit margins are always better, but, depending on your industry, 9 might be a awesome year, or 9 might be an absolute disaster. Just depends. Gross margin is gross profit divided by net sales. Okay, so that has to do with how much it costs to make the products that you sell. In the case of this company, it costs quite a bit. 70% or so of what we sell it for, we've got to spend just to make it. Okay, only going to keep 30%. Times interest earned is, remind myself here, it's interest expense, operating profit divided by interest expense. So it basically says that operating profit, how many times over could you pay your interest expense? So, the amount of debt to carry, the amount of debt to use, the amount of leverage, however you want to put it, to utilize is another subject that deserves its own spreadsheet and video. But in general, let's put it this way: the bigger this number times interest earned, the less risk you're taking, is kind of a general rule of thumb. Risk is a tricky subject, but let's put it this way: at 42 times interest earned, this company's in no danger of not being able to make its interest payments. Okay, the year could go a lot worse, and they could still cover those interest payments and not be at risk of having to declare bankruptcy. degree of financial leverage and degree of operating leverage. These two, I think I mentioned earlier, are getting their own treatment, spreadsheets and videos, because they're interesting subjects, and I won't get too much into them here, but basically what they say is the degree of financial leverage is the degree to which borrowing more will help you or hurt net profit. Okay. At 1.02, it means that any percentage change in operating profit will be amplified by 2%. So a 10% increase in operating profit would equal a 10.2% increase in net profit. Okay, based on the amount of money we borrowed, based on the amount of our interest expense. Okay, a 10% decrease would equal a 10.2% decrease in net profit. Okay, again, I will expound on those topics at a later date, but that's the thing with leverage. It amplifies. If you do good, leverage is going to amplify how well you do. If you do bad, leverage is going, in this case financial leverage, borrowing money, is going to amplify how bad you do. Degree of operating leverage is similar, but the fixed expense is not interest. It is fixed costs. All fixed costs. Okay, fixed costs, so fixed overhead and fixed costs in the SG&A budget, which is why that's an option there to choose whether the department's variable or fixed. Okay. It has to do with a concept called contribution margin. Excuse me. The principle's the same, okay, as with the degree of financial leverage. All right, so it's 2.47 in our little hypothetical company here. So a 10%, but in this case it has to do with sales, not with operating profit. Okay, so a 10% increase in sales with the fixed cost that this company has would translate into 24.7 increase in operating profit. Okay, it's leverage, so it amplifies. Sales go up 10%. Good. Okay, it's going to amplify how good that is, because it's going to increase your operating profit, not 10%, 24.7%. Huge jump. Okay, huge jump here, huge jump in net profit then, right? Converse is true. If you have a relatively minor, nobody wants 10% drop in sales, but particularly this company wouldn't, because of its degree of operating leverage. So a 10% drop in sales is going to equal a 24.7% drop in operating profit. Boom, that hurts. That's a quarter of your operating profit gone. All right, so again, those topics will be expanded upon hopefully very soon. The degree of financial leverage spreadsheet is done. I've just got to get the post written and get a video made eventually. Yeah, the last part here is the components of operating income, which just kind of break down everything that you enter throughout the entire budget. Okay, and it's labeled here. Green's your sales for a given month. You've got your SG&A expenses in black, your overhead in gray, your direct labor in red, and your direct materials in tan. And it just gives you the opportunity to kind of see how they fluctuate month by month, and kind of visualizes everything that you entered across the course of all those budgets. So I don't think I made my goal of clocking in under an hour, but man, did I try. Right at an hour, more or less. Okay. All right, well, let me wrap it up then. If you stuck with me this long, thank you very much. I appreciate it. As you're probably aware, YouTube and the internet in general. It's kind of a popularity contest. So if you found something valuable here, if you went to the site, downloaded the spreadsheet, that's great. That's what it's there for. At this point, I'm not trying to sell anything. I'm just trying to put out good information to build up an audience, to get, to get some traction. Some traction for my videos, some traction for my website. So if if you like what I've done here, then throw in a tip my way, not a cash tip, a like tip or a subscribe tip or an alert tip or any of those other things that just send a positive message to the Google overlords that what Spreadsheets for Business puts out is good stuff, and if you could let them know that, I would certainly appreciate it. But anyhow, that's it. If you have any questions about what I covered here, again, I kind of pushed through it, hopefully not too fast, but I tried to be thorough. Go ahead and put them down in the comments. The only thing I ask is questions are fine. If you're learning about this, then you're gonna have questions. This stuff's new to you. That's cool. What did I have a boss tell me one time? And I thought this is good advice. Don't bring me a problem. Bring me a problem and a solution. If you have a question, that's fine. Just put down what you think the answer to that question might be. There's a good chance you're probably right. You figure it on your own, and we'll myself or maybe another commenter will get back with you and help you out with that. So anyhow, it's as I record this, it's about bedtime for me, so I'm gonna clock out. Again, thanks for watching. Take care.